Check this out. Over the last decade, a single ETF delivered a jaw-dropping 525% total return. That's enough to turn $10,000 into more than $62,000.
But, and this is a huge but, that very same ETF went cratered, losing over 80% of its value and absolutely wrecking portfolios during the dot-com bust.
Today, we're doing a full institutional breakdown of one of the most powerful and, honestly, one of the most misunderstood ETFs out there, the Invesco QQQ Trust.
Okay, before we dive in, here's our quick but very important disclaimer.
All right, let's get right into it. So, first things first, what exactly is this thing? Well, let's start with its fundamental promise, performance. At its core, QQQ is an ETF that's built to track the Nasdaq-100 index. Now, it's really important to understand this isn't the entire Nasdaq. Nope, it's a curated list of the 100 biggest, most innovative companies, but with one big exclusion: no financial companies. So what you're really getting is this incredibly concentrated shot of the biggest names in tech.
And the scale here is just massive. I mean, look at these numbers. We're talking about almost $400 billion in assets. It's a giant, but what's really telling is the trading volume. It is the second most traded ETF in the entire United States. That tells you just how fundamental this thing is to the daily machinery of the market.
So what's really going on under the hood? Let's take a look at the actual engine that drives all this growth.
This chart pretty much says it all, doesn't it? This fund's DNA is tech through and through. A full 60% is in information technology. Then you pile on another 30% from tech-heavy sectors like communications and consumer discretionary. But you know, what's not here is just as important. There is zero exposure to financials, energy, or utilities. It's a pure play on innovation.
And this is where that concentration really hits you. Just look at these names. The famous Magnificent Seven. NVIDIA, Apple, Microsoft, and the rest, they make up almost 40% of the entire fund. Think about that. This is the very source of its incredible power, but it's also its greatest vulnerability.
And that brings us perfectly to the other side of this high-performance coin. Let's talk about the price you pay, and let's actually quantify the risk involved.
This chart right here is the whole story. It's the perfect picture of that double-edged sword. In 2023, when AI fever was taking over, QQQ put up a monster 55% return, more than double the S&P 500. Amazing, right? But just look at the year before. In 2022, when the Fed was hiking rates, it got crushed, following almost twice as hard as the broader market. So, QQQ doesn't just follow the market, it magnifies every single move, up and down.
And those magnified down moves, they can be absolutely brutal. The dot-com crash wasn't a dip. It was an 83% wipeout that took a decade and a half to climb back from. Even recently, we saw big, painful drawdowns during the COVID crash and the 2022 bear market. This is definitely not an investment for the faint of heart.
So let's just boil down the risks you're signing up for. You've got huge concentration risk, where bad news for one company can rock the whole fund. You've got extreme sensitivity to interest rates. You have massive blind spots to entire parts of the economy. And you've got zero international diversification. It is 100% a bet on U.S. stocks.
Okay, so with all of those risks laid bare, how should an investor actually think about using QQQ in a real portfolio? Let's stack it up against some of its peers.
So here we've got QQQ next to its cheaper twin, QQQM, and the big S&P 500 ETF, VOO. The differences just jump right out at you. QQQ's expense ratio is much higher than VOO's. It's way more concentrated, with only about 100 holdings versus over 500 for VOO. And that last line is the kicker: the worst-case drawdown is more than double that of the broader market.
Now, listen up, because this next point is absolutely critical if you're thinking about buying this. Invesco actually created a sibling fund, QQQM. It holds the exact same stocks, but it's cheaper. So why do both exist? Well, QQQ is for traders. It has insane liquidity for options and high-frequency guys. For pretty much any normal, long-term buy-and-hold investor, QQQM is the better choice. You get the same thing for a lower fee.
So, who is this really for? It breaks down into three camps. For long-term investors who want to add a shot of growth to their portfolio, using QQQM as a smaller satellite position makes a lot of sense. For active traders and options users, the original QQQ is your tool.
But for conservative investors or anyone close to retirement, just avoid it. The volatility is just not worth the risk.
All right, let's pull all this together and land on a final verdict.
You know, the core trade-off here is incredibly simple, and it's stark. On one hand, you get this unparalleled exposure to American innovation and a track record of absolutely spectacular returns. But on the other hand, you are accepting extreme risk concentrated in just a few giant companies, and the very real possibility of gut-wrenching losses.
So in the end, QQQ is a high-conviction bet. It's a vehicle powered by innovation, a pure play on the idea that U.S. tech will continue to lead the world. But making that bet requires an equally high tolerance for volatility and risk. You have to have an iron stomach. Which really leaves us with just one final question for you to consider. QQQ offers some incredibly powerful growth, but is your portfolio really prepared to pay the price?
If you appreciated this kind of deep dive analysis, make sure to subscribe for more institutional-style breakdowns.